Welcome to CoreLogic's update on Australian housing market conditions for July 2016. The pace of capital gains showed some moderation over the month of June, slowing to 0.5% after CoreLogic's home value index surged by a total of 3.3% over the previous 2 months. Although the headline results showed a reasonably strong rate of growth in dwelling values, 5 of Australia's 8 capital cities recorded a fall over the month of June. Monthly declines of more than 1% were seen in Darwin and Adelaide and Canberra, while the falls in Brisbane and Perth were less severe. The June growth figures can be attributed once again to strong gains in Sydney and Melbourne, where dwelling values rose by 1.2% and 0.8%. Hobart also showed a substantial rise of 1.8% over the month. While the higher rates of capital gains in Sydney and Melbourne can be tied back to strong economic conditions and high rates of population growth, the same can't be said for Hobart, where economic conditions and migration rates are gradually improving from a low base. The rise in capital city dwelling values in June has pushed the year-to-date growth figure up to 5.5%, which is slightly higher than the 5.1% increase recorded over the first half of 2015. With the recent surge in monthly growth, the annual pace of capital gains has rebounded from a recent low of 6.4% earlier this year to reach 8.3%. However, the annual trend remains well below the peak of 11.1% seen in July last year. While home values are continuing to rise, rental markets are experiencing very different conditions. Over the 12 months to June 2016, combined capital city rents have fallen by 0.6%, which is their largest annual fall on record. The only cities to record a rise in average house rents over the past 12 months have been Melbourne, Hobart and Canberra. The remaining capital cities all saw rents fall over the past 12 months, with the largest declines in Darwin and Perth, where average weekly house rents were down by 12.9% and by 8.7% respectively. With home values rising and rental rates contracting, investment rental yields have compressed to new record lows in June. Capital city gross rental yields are currently recorded at 3.3%, down from 3.6% a year earlier. The Hobart unit market's the only capital city to record a rise in rental yields over the past year, thanks to a strong rise in weekly rents over the past 12 months. Sydney and Melbourne are showing the lowest rental yields of any capital city, with houses providing an average gross yield around the 3% mark in both cities, while unit yields are slightly higher, averaging about 4%. The lowest yield scenario implies that most investors would be experiencing a negative cash flow situation on their investment properties, at least over the first few years of ownership. In a sign that buyers might be finally getting some leverage back in the marketplace, the average selling time is now starting to move higher across the capital cities index. The average selling time is currently tracking at 45 days for those homes sold by private treaty, compared to 39 days a year ago. One of the largest jumps in average selling time is in Sydney, where the average sale period has extended from 26 days a year ago to 40 days. Vendor discounting rates are also generally expanding, suggesting sellers are having to offer up higher discounts on their initial listing price in order to make a sale. Both of these indicators provide a hint that housing market conditions may be moving through the peak of the cycle. The Perth housing market has continued its trend of weak capital growth conditions, with dwelling values falling a further 3% over the June quarter. Since the Perth housing market peaked in December 2014, dwelling values are down by almost 7%. Arguably more concerning is the fact that weekly rents are now down by almost 9% over the past year for houses and 7.6% lower for units. The fact that both dwelling values and dwelling rents are falling across Perth is a firm indication that buyer demand remains weak and prospects for capital gain remain dim. Residential properties are taking on average 69 days to sell, and vendors are discounting their initial asking prices by an average of 7.8%, highlighting this is well and truly a buyer's market. The growth cycle has now been running consistently for 4 years, taking capital city dwelling values 37.3% higher over the cycle to date. Sydney has well and truly outpaced all other capital cities for appreciation and dwelling values, recording a 59.3% capital gain over the cycle to date. Melbourne dwelling values are 40.5% higher, with the next best performing capital city being Brisbane, with a much lower growth rate of 18.3%. Such a strong and sustained rate of appreciation has pushed rental yields to a new record low and caused a deterioration in affordability, especially in Sydney and Melbourne, where the pace of capital gains has been remarkably high. The June reduction in the monthly rate of growth is likely to be very much welcomed by federal and state government policymakers and regulators who may have been becoming concerned about a sustained rebound in capital gains. In our view, the rate of capital gain is likely to decelerate further over the remainder of the year due to a range of factors, including affordability constraints, low rental yields, and a growing acceptance that the growth cycle is likely to be at or close to its peak. Recent dwelling price to income measures released by CoreLogic using household income data from the Australian National University show Sydney's dwelling price to income ratio has reached 8.2, indicating that dwelling prices are now 8.2 times higher than annual household incomes. Melbourne shows a healthier affordability index compared with Sydney's. However, dwelling prices remain 6.8 times higher than household incomes. As the year progresses, further interest rate cuts are likely, which could bring mortgage rates down even further. Whether lower mortgage rates will stimulate the housing market is yet to be seen. However, a rebound in home value appreciation is likely to be on the regulatory radar. If the pace of capital gains remains consistently high, there's likely to be a potential for further regulatory response aimed at keeping a lid on the pace of capital gains in the housing market, whilst also allowing low interest rates to stimulate the broader economy. As always, thanks for tuning into the CoreLogic overview of Australian housing market conditions. There's plenty more research and housing market insights at our website located at www.corelogic.com.au.